Please stand by. We're about to begin. Good day and welcome to the Alston and Bird Weekly Client Update. Today's session is Sales of Partnership Interest. Today's call is being recorded. At this time, I would like to turn the conference over to Scott Harty. Please go ahead, sir.
Good morning. Thank you very much. Thank you, everyone, for dialing in this morning and participating. Again, my name is Scott Harty. I'm a partner in the Federal and International Tax Group with Alston and Bird. And this morning, I'm joined by Danny Reach and Seth Buchwald, who are members of our tax group. This week, Danny and Seth are joining us to review the new rules passed by the TCJA related to sales of partnership interests and proposed regulations that have been released. Just a bit of housekeeping real quick. The slides should be available, so if you can't access those now, please let us know and we can make sure that you can access them if you want to follow at your own pace through the presentation. Also, after today's presentation, we're going to take a short break and then regroup in the coming weeks with a series of new presentations, so please stay tuned for that announcement. So our roadmap for today, just briefly, we're going to begin by just reviewing the law in this area prior to the passage of the Tax Cuts and Jobs Act, just to provide a little context for what is to come. And then we're going to review new sections 864C8 and withholding provisions under 1446F as they relate to sales of partnership interests, and then finally conclude with several observations. So during the call, we always welcome questions. So if you have any, please go ahead and submit those anytime during the call. We'll try to get back to you if we can during the call. If not, we'll definitely send you a reply afterwards. So let's get started. Just real quick to introduce Danny and Seth. Danny is in our Charlotte office. He practices in tax planning and structuring for domestic and international business entities and individuals. He assists clients in restructuring global operations and provides tax and corporate advice in connection with M&A transactions, structured financing, cross-border securitizations. Similarly, Seth counsels clients on a variety of domestic and international tax issues related to mergers and acquisitions and complex business transactions. So we are thankful to have both Danny and Seth with us today. And with that, I'm going to turn it over to you, Seth, to kick us off.
Hey, everyone. Thanks for being with us. I just wanted to provide kind of a general background of what we're talking about and what was passed with the Tax Cuts and Jobs Act, the issue it was trying to address. Prior to tax reform, the Tax Cuts and Jobs Act, there was a conflict in the law how gain on the sale by a foreign partner of an interest in a partnership, be it a domestic partnership or a foreign partnership, that conducted a U.S. trade or business would be treated. A question as to whether or not that foreign partner would be subject to U.S. tax as ECI on any gain from the sale of that partnership interest. Just a little background on the law. Generally, if a foreign partner is deemed to be indirectly engaged in a U.S. trade or business of a partnership that is itself engaged in a U.S. trade or business, so the U.S. trade or business from the partnership will essentially flow through to the partner. Similarly, a foreign partner's distributive share of partnership income that is considered effectively connected income, ECI, which the general rule for something to be ECI is it has to be U.S. source income, will also be ECI for the foreign partner. Again, flows through the ECI characterization at the partnership level, flows through to the foreign partner. In the asset sale context, if you think of a partnership, domestic or foreign, that owns or engaged in a U.S. trade or business that sells its underlying assets and that generates effectively connected income, that ECI would flow through to the foreign partner, and that foreign partner would be subject to U.S. tax on the sale of the partnership's assets. In the context of if that foreign partner were to sell its interest in the partnership, it was a little unclear prior to tax reform as of 2017 what the status of the law and whether the foreign partner would be subject to U.S. tax. So on this slide we're looking at, you can look at the general source rule, which generally says gain on the sale of personal property, a capital asset, or a partnership interest in this context is sourced to the residence of the seller. So if a foreign person is selling its interest in a partnership, the general rule would say that's foreign source income, and the foreign partner would not be subject to U.S. tax. It would not be ECI. There is an exception if the income that arises from the sale of that personal property, in our case, the partnership interest, is attributable to a office or fixed place or business in the U.S. Again, in our context, it would be the office or fixed place of business of the partnership itself, and whether or not the income arising from the sale of the partnership interest would be deemed attributable to that. And in the code, there's a statute that kind of evaluates what it means to be attributable to an office or fixed place or business. It looks to whether the business is a material factor in generating that income, and whether or not the income is derived from activities that are regularly carried on by the business. So those are just kind of the background on the law. Where the conflict arose is you have this old revenue ruling. It was a 1991 revenue ruling that I imagine a lot of people are familiar with. It was Revenue Ruling 9132. The situations in both this revenue ruling and the Grecian Magnesite case, which caused the conflict, are very similar. It's the sale by a foreign person of an interest in a partnership. I believe they're both domestic partnerships, and the foreign partner had gain. The question is whether or not that gain is considered ECI and subject to U.S. tax. In the revenue ruling, the IRS adopted an aggregate approach to partnerships. And essentially, the IRS looked through the partnership to the underlying assets of the partnership and characterized the gain on the sale of the partnership interest based on whether or not those underlying assets, if sold, would have generated effectively connected income. The IRS basically went with the exception. It didn't use the general rule, residence of the seller. It went with the exception and converted what would otherwise be foreign source gain on the sale of the partnership interest to U.S. source, under the guise that the gain on the sale of the partnership interest was attributable to the underlying partnership's U.S. office or fixed place of business. So that was the kind of the standard for a long time. It was not necessarily looked at favorably upon by the tax community, mostly because of the fact that the income was being generated to a foreign person by the sale of a partnership interest, and a lot of people had trouble seeing how that could be attributable to an underlying trade or business that is totally unrelated and the foreign person isn't necessarily even involved in. So fast forward to 2017, July was really the first time that this IRS holding was challenged formally. And the tax court came out with a holding, basically ignored Revenue Ruling 9132. Instead of taking an aggregate view of the partnership and looking through to the partnership's assets, as the IRS did, the tax court took an entity approach and viewed the partnership as a distinct entity, and therefore the sale by the foreign partner of that interest as a distinct transaction, essentially, separate apart from the underlying partnership assets and the business it was conducted. The tax court in Grecian held that the sale of the partnership interest was not attributable to the underlying U.S. office or fixed place of business of the partnership, and then it was not U.S. source ECI subject to tax. Unlike the IRS revenue ruling, the tax court decided to go with the general rule, residence of the seller, and here's an interesting, the sub-bullet point kind of gives the reasoning of the tax court, saying that the gain from the sale of the partnership interest was not attributable to the partnership's U.S. office or fixed place or business. And the place of business was not a material factor in the production of income from the sale of the partnership interest. Furthermore, the gain to the foreign partner did not arise in the ordinary course of the business being conducted through that U.S. office or fixed place of business. Grecian was a magnesite mining company. The partnership was involved in the magnesite mining business in the U.S. And the tax court viewed the gain that arose to the foreign partner as not attributable to that business. So we had a bit of a conflict. You have, Grecian magnesite mining saying the foreign partner's gain from the sale is foreign source, not subject to U.S. tax, taking an entity approach, and you have the IRS revenue ruling, historical revenue ruling, saying basically the opposite, that you take an aggregate approach, look through the assets of the partnership, and deem at least some of the gain to the foreign partner U.S. source subject to tax. And I will let Danny tell us what tax reform did to correct, at least address this and provide some guidance.
Yes, and perhaps, the recency of the Grecian Magnesite ruling made it possible for when Congress, sort of took the pen with the new Tax Cuts and Jobs Act to take the opportunity to try to speak definitively on the matter. So in 864C8 in the Tax Cuts and Jobs Act, it effectively overruled Grecian Magnesite and basically adopted the approach of 9132. It is effective for dispositions of partnership interests on or after November 27, 2017. We have proposed regulations that were issued in December, and those would also apply on that date going forward unless they're finalized in late June or later, in which case the regs themselves and the rules in there are going to apply as of December 2018. So the regs do a couple of things. They expand dispositions to include distributions, but only to the extent that gain is recognized on a distribution. The classic example is a distribution under 731 where you recognize gain to the extent cash distributed is in excess of the partner's basis, as well as disguised sales of partnership interests. And, as we'll get into in greater detail in some later slides, the gain is calculated based on the deemed ECI that would be produced if the partnership had a deemed asset sale, a hypothetical sale of all of its assets at fair market value, on the date of the disposition of the foreign partner's interest in the partnership. The proposed regs also include some tiering rules. So they apply this aggregate approach when, on the one hand, there's a sale by a foreign partner of an interest in a partnership that has lower tier partnerships as well, or where a foreign partner is a partner in a partnership that itself sells an interest in a lower tier partnership, and they generally sort of calculate this hypothetical deemed sale gain from the bottom up. And so, stepping back a little bit, the general purpose of these of this new statute is to protect the ECI tax base of the U.S. and to equate, in a general sense, a partnership interest sale with the results from an ECI perspective that you would see if the partnership itself has sold assets. And that's a lot like the holding in Rev Ruling 9132, except there may be one interesting distinction here. So in the proposed regulations, they seem to bypass the resourcing approach that 9132 used. 9132, as Seth mentioned, basically redetermines source that otherwise would be a foreign source based on the sale of an interest in a capital asset to U.S. source by attributing the office of the partnership to the partner that's selling its interest. In the proposed regulations, they take a somewhat different approach and recharacterize source based on the deemed asset sale. So they don't address directly the source of the foreign partner's gain on the partnership interest. They just determine the sourcing rule within the context of the deemed asset sale for purposes of attributing that ECI to the partner's gain. And so there is a potential that some of this gain could be foreign source ECI, and that could be potentially beneficial for foreign tax credits. For example, if a foreign jurisdiction, the foreign jurisdiction of the foreign partner imposes tax on the partnership interest sale, if that is foreign source ECI in the U.S., there's a possibility that that partner can offset its U.S. ECI, tax on ECI, against those foreign tax credits. All right, so, in tandem with 864C8, new 1446F was codified, and so that basically imposes a withholding obligation in connection with deemed partnership interest sales that give rise to ECI. So this is effective for dispositions after December 31st, and the rule basically says that the partnership, in a transfer of partnership interest, 10% of the amount realized is the amount that needs to be withheld. So even if $1 of ECI gain triggers the potential for ECI gain on a partnership interest sale, 10% of the entire amount realized is the amount subject to withholding. An important feature of this is that a partnership itself can be secondarily liable, so it must withhold tax plus interest, and that withholding obligation applies with respect to the partnership's distributions that it makes to the transferee partner. So it has sort of secondary withholding liability plus interest in a sale by a foreign partner that can give rise to ECI. Importantly, there are statutory exceptions very similar to the FERPTA rules that allow a transferee of a foreign partnership, of an interest that gives rise to ECI to a foreign partner from this withholding obligation if it provides a certificate with some information, the EIN, some sort of proof that the foreign partner is not really foreign, the partner is not foreign. In 2018, the IRS issued 2 notices. The first one temporarily suspended the withholding obligation for publicly traded partnerships. We may see the regulations come out at some point this year, and many expect that will have special rules for publicly traded partnerships, allowing sort of brokers of publicly traded partnerships to have the withholding obligation, because it may be too difficult logistically for transferees in publicly traded partnership interests to do the withholding. And then a more important notice, 2018-29, did provide some interim substantive guidance in the context of non-PTP partnership interests and these withholding obligations. So it also temporarily suspends the withholding for partnership secondary withholding, and also applies sort of 2 exceptions based on a 25% threshold of ECI. And importantly, it provides some leeway for taxpayers to use the FERPTA rules relating to withholding on dispositions of U.S. real property interests, with a few modifications to exempt some transferors from this withholding requirement. Another important feature of the notice is there's an automatic reduced withholding in certain circumstances where the amount realized is greater than the amount that the transferee received, or the transferor received, except for distributions in excess of basis, think 731 transactions that result in gain. And this is important because in 1445 there's a similar rule, but you have to seek consent from the IRS, or you have to seek a certificate from the IRS first. And this is a helpful development here in 1446F withholding, because it provides that sort of relief automatically for transfers that apply.
Hey, Danny, this is Scott.
Yeah.
Just a real quick question on that third bullet point and using rules under 1445. I know that the 2018-29 may not be as detailed, but in the 1445 rules, it basically says that a buyer isn't obligated to obtain certification, and if the buyer chooses, they can rely on other means to determine if the seller is a non-foreign person. So there's no affirmative obligation to get the certification, although if you use other means and the seller ends up being a foreign person, you're subject to withholding. So I think everyone agrees you should get certification. But if you choose to use other means, is that possible under 1446, or under 1446, are you just required to get certification even if the seller is a U.S.? You just have to get certification. So do you think that notice provides any light on that?
I think it's ambiguous right now. The notice does say that you're allowed to apply the principles of 1445, including the general regulation that you're referring to that has that other means alternative. So, it remains to be seen. It's unclear right now, but probably best practice is to continue to get certificates in any case where there's a partnership interest transfer and there's any risk that this withholding could apply. Yeah.
Okay, thanks.
So I also want to touch on a few open issues in 1446F withholding. I'm going to highlight them briefly, but these can be potentially the subject of a whole different webinar because there's lots of them. So on the secondary liability of the partnership, which, as we mentioned, is suspended for now until final regs are issued by the notice. Question is a partnership required to request a certification, or can it rely on a certification obtained by a transferee? And also, is the liability cut off in successive transfers? One can envision some sort of step transaction principles applying where there's a plan to do successive transfers where you effectively cut that off if that's the case. So that's an open issue. Also, disguised sales. So, in the classic disguised sale example here, it would be, contribution of property by one partner and then a transfer of a distribution of cash to another partner, here to a foreign partner in redemption of its interest in the partnership. So that would be a disguised sale potentially. But that can occur, over a different period of time. And so a logistical question is, the contributor in that scenario is theoretically the transferee, but it would be difficult logistically for that partner to know that it had to obtain a certificate and comply with that withholding, and it seems like it may be the partnership that would be the best party to comply with this withholding regime in the case of disguised sales. So that's a unique aspect of that, and we know that disguised sales are implicated. Another open issue are asymmetric transfers and 99-6 transactions, and those are, there's two situations in that revenue ruling, and basically the acquisition of a partnership interest that results in the partnership terminating because it becomes a disregarded entity. One scenario where an existing partner buys out the other partner and that terminates the partnership, or another scenario is where a third party buys out all the existing partners, causing it to terminate. And that ruling is important because it treats the sellers as selling partnership interests, but the acquirer as acquiring assets in those transactions. And so 1446F technically only applies to the transferee of a partnership interest. So I think the argument can be made that in a 99-6 transaction, the transferee has the potential to argue that it doesn't apply because it's not acquiring a partnership interest, it's acquiring assets. So we may see some clarity on that in the final regulations. And, an important side note, in light of the removal of the technical termination rule, 708B1B, also part of tax return, there's been increased focus in a general sense on these 99-6 transactions. So now when there's foreign sellers, that may be additional wrinkle for folks to consider. Finally, 731 distributions, which we've talked about, where it only applies, we know that the withholding obligation only applies to amounts in excess of basis that creates the gain, potentially treated as ECI. But, it's unclear based on the notice and the statute whether the 10% of amount realized hook applies on this excess amount in excess of basis or on the full distribution under 731. Hopefully it's only on the excess amount, but right now unclear.
All right, so under the proposed, go ahead. Sorry, Danny.
No, I was just going to pass it on to you for calculation of the gain and loss on ECI.
Sure, and this calculation is a bit complicated. I'm going to go through it pretty quickly just in the essence of time. But so if you looked at the statute 864C8 that was brought about by the Tax Cuts and Jobs Act, it provides this formula, as we said, where you look through to the underlying assets of the partnership and determine which one of those, if sold, would generate ECI. And then there's a comparison of that amount to the actual gain the foreign partner would recognize on the sale to determine the amount of ECI to the foreign partner. The proposed regulations basically lay out the formula in more detail. There's a lot of nuances to it. It's complicated, but I'll do my best in these 3 bullet points to just quickly give a high-level summary. The first thing you have to calculate, like usual, is the foreign partner's outside gain. The most important thing is to keep the ordinary and the capital components of that gain separate. If a foreign person sells their partnership interest at a gain, it's generally going to be capital gain. but the general rules of Subchapter K do apply, so you could potentially have recharacterization to ordinary income for hot assets or other items. So once you have that outside gain, again, maintaining your ordinary and capital components is very important. You do the hypothetical sale of the asset. So you determine the foreign partner's distributive share of the ordinary and capital components, separate again, as if the partnership sold all of its assets to an unrelated third party in a fully taxable transaction immediately before the partner transfers its interest for cash equal to the asset's fair market value. This is known as the limiter. One thing that's important to note is this calculation is always done based on as if the partnership sold all of its underlying assets, and we'll see in an example in a second that even in the context of a partial sale of a foreign partner's interest, if I sell 50% of my interest, the calculation is still going to be based on as if the underlying partnership sells all of its assets. The proposed regulations fortunately come in and provide some guidance that the full amount of the ECI is not going to be accelerated, and we'll see that in a minute. So once you determine this limiter amount, it's your distributive share of basically of the ECI generated from a hypothetical sale of the underlying assets, again, maintaining your capital and ordinary components. You compare the two values, and the amount of that limiter is basically going to be the ECI that flows through to the foreign partner being subject to U.S. tax. Again, you have to compare the distributive share of the ordinary component and the capital component, and that's what makes it really complex, is you kind of have to keep up with these two separate axes, essentially, to do the calculation. I think, Danny, you are next.
Yep. So, once you calculate the limiter, then, the proposed regs basically deem a sale of all the assets to be attributable to an office or fixed place of business of the partnership and U.S. source as a general matter, and then they do not resource that to the extent it's, assets are sold for use outside the U.S. in a scenario where a foreign office of the partnership materially participates, unless a 10-year exception applies. So it seems to be it seems to have the potential to be over-inclusive. You have a deemed asset sale and, as a general matter, allocate that to the U.S. office, and then you can only sort of deem that to be foreign source if this exception applies and there's material participation by a foreign office. And the 10-year exception says you had no income produced by the asset that was ECI during the last 10 years, and the asset was not used or held for use in a U.S. trade or business in the past 10 years. And the proposed regs apply this on an asset-by-asset basis. So, question whether that's intended for all assets or whether there might be a simplifying or unifying convention. For inventory, for example, it seems difficult to apply that on an asset-by-asset basis. There may be different types of inventory to consider, and maybe you consider all types of inventory together in different baskets. So those are questions that are still open on that calculation.
All right, just to put some numbers to what we've talked about, this is a very simplified example, but I think it hopefully will shed some light to everybody. Here we have an operating partnership, OP, the triangle, that has underlying assets, some of which are attributable to a U.S. trade or business, some of them are not. We have kept it simple here, and every one of the assets would generate capital gains or capital loss. They're all capital assets. I reiterate that in this calculation, what makes it really hard is you have to keep both the ordinary and the capital components separate. But in the essence of simplicity and just getting a feel, that's how we're doing it here. So again, our comparison we've been making the whole time, an asset sale if the partnership were just to sell its underlying assets versus as if the partners sell their interest in the partnership. If for an asset sale, if OP were to sell its assets, FP, the foreign partner, would have $50 of ECI. That's the $100 of gain that would be recognized on the USTB, U.S. Trader Business side. That would flow through 50% to the foreign partner. Now, under 864C8, the calculation, if FP were to sell its entire 50% interest in the operating partnership, the first thing we calculate per my slide 2 slides ago is the outside capital gain. It would be $100. We're assuming no hot assets or anything here. So FP's total outside capital gain is $100. The next thing we need to calculate is FP's distributed, or I guess it would be the hypothetical deemed sale of the underlying assets of the partnership. So that would generate $100 of deemed sale ECI, the $100 from the U.S. trader business. It would generate also $100 of non-U.S. trader business, non-ECI income, but for the purposes of what we're talking about, that's kind of irrelevant. And FP's distributive share of that deemed sale ECI, the $100, would be $50. Again, that's the $100 from the sale of the assets of the U.S. trader business that flow up through the operating partnership, and 50% of that flows to the foreign partner. That's the limiter. Therefore, out of FP's total $100 gain on the sale of its partnership interest, $50, the amount of the limiter, would be treated as ECI for purposes of U.S. taxation, and $50 of it would be non-ECI. Again, that would be capital gain in this context, but there's the potential that you could have both ordinary income ECI and capital gain ECI. And Danny's going to walk through the example on the next slide as if the foreign partner does not sell his total interest.
Yeah, and you know, the examples in the proposed regulations also provide an example in the more complicated scenario where the partnership has a mix of both capital and ordinary income assets, and is helpful in showing how this sort of plays out in that scenario. So the point of this slide and this example, which has the same facts, is just similar facts, but the foreign partner just sells half of its interest instead of all of it. Is to just show that in the deemed sale, where a total of $50 of gain would have been ECI in the deemed sale of assets, here only the proportionate amount relating to the proportion it sold is treated as ECI. So here it has a gain of 50 instead of 100 on its sale of its partnership interest, but only 25 of the ECI gain from the deemed sale of assets is attributable to this sale. So only $25 would be ECI and $25 would not. Then later on, when the foreign person sells the remainder of its interest, presumably the remaining $25 gain, if it hasn't changed, will be recognized as ECI then. The statute was somewhat unclear on that, but the proposed regs seem to have cleared that up. All right. The proposed regulations also discuss non-recognition transactions. They basically just say that they won't recharacterize as ECI a portion of gain that's subject to a non-recognition provision under another provision of the code. But they're continuing to study 731 distributions in particular, again, to make sure that they're keeping with their intent to protect the ECI tax base in the case of a partnership interest sale by a foreign partner. So in one example, a partnership has 3 partners, 2 of them are domestic, 1 is foreign, and the partnership has both trader business assets and non-trader business assets, and then the partnership redeems the foreign partner just for the non-U.S. trader business assets and an otherwise tax-free distribution. That would be one scenario that the IRS may be considering in continuing to study these particular non-recognition transactions. So, treaties as well. The proposed regulations speak to treaties. They basically say that the permanent establishment paragraph in most treaties will preserve the U.S.'s taxing jurisdiction, so treated in the same way as gain of ECI under the code. So an important aspect of this is 9132. It did talk about treaties specifically, but the code itself and the legislative history of 864C8 didn't discuss the treaty context. So it's interesting that the proposed regulations took a stance on this and effectively applied the deemed sale construct in the case of treaties where the analysis takes the form of a permanent establishment of the partnership.
And lastly, just another thing the proposed regs addressed was the interaction of the new provision 864C8 with FERPTA. It makes clear that the FERPTA takes a back seat essentially to 864C8 if both are applicable to the underlying assets of the partnership. That would be in the case of U.S. real property interests. Interesting to note, there is a provision in the statute, 864C8 capital C, which prior to the proposed regulations indicated that you would reduce the foreign partner's ECI gain that was calculated under the general rule by amounts that were subject to FERPTA withholding. But now that the proposed regulations make clear that FERPTA doesn't apply in the context where 864C8 does, that provision is kind of null and void. It's almost unnecessary. And the proposed regulations kind of indicate that that is no longer applicable. And with that, I think we'll pass it back to Scott.
Okay, thank you, Danny and Seth. We appreciate it. So we went a little bit long, but as you can tell, there's a lot to digest here, and I think you could probably split these topics up into separate presentations just on 864 and 1446, which we may revisit once the regulations are finalized. But if you have questions, please feel free to email us. The slides will be available, as well as the slides and presentations for all of our prior presentations. And if you need any help accessing those, just please let us know. We do thank you for joining us. We appreciate your participation in this series. Please do stay tuned. We do hope to announce future presentations in the coming weeks, and hope you will be able to join us then. So thank you very much, and hope everyone has a good week.
And that will conclude today's call. We thank you for your participation.